Also with us, Larry Kantor, the head of research at Barclays Capital. He called the stock market bottom back in March of 2009. Now says U.S. stocks are ready to rise because of a stronger economy and increasing corporate profits. So, Larry, let's hear from you. So you're pretty upbeat despite the downtrend we've seen since that April high. Why?
Yeah, well, we've had a setback. And for one thing, stocks now look a little better from a valuation perspective. And look, the one negative here is volatility is back and uncertainty. You know, it's disturbing to see policymakers struggle responding to a setback. That's sort of reminiscent of what we saw in 08 and 09. And so that's a negative. I mean, you know, that things are fluctuating a lot more and you can have these kind of setbacks. On the other hand, we don't see this as a global sovereign debt crisis. In fact, the interest rates in both the UK and the US, two countries with big budget deficits, have actually gone down. We don't really see this hitting economic growth. In fact, in the U.S., offsetting the stronger dollar, we're going to see lower gasoline prices, and we're seeing lower interest rates. Even within Europe, sure, fiscal tightening is going to hurt, but they have a lower euro, which is going to help their exports, and their interest rates are down too, and the ECB is now buying bonds. So we see the global economic backdrop is still very strong. People say it's a liquidity crisis. You know, you're just not seeing anything near what you saw back in 08 and 09. So most of the banks still are able to access liquidity. So we see this backdrop. In fact, if anything, this is going to delay policy tightening. So we're still going to have policy rates around zero, and that's a pretty good environment when you're in an economic recovery for the stock market.
Larry, aren't you concerned, though, about the stability of the European banking system? I mean, German and French banks alone exposed to about $1.5 trillion of losses from debt in Greece, Spain, Portugal, Italy, Ireland. I mean, that's a big number. And, you know, when big banks collapse, the market feels it.
Yeah, but I think it's going far. It's one thing to say they're going to suffer losses, and they are. There's still more write-downs and losses to go, and they are exposed to this debt. It's another thing to say that they're going to collapse. And, you know, we've just been through a period in 2008 and early 2009 where they're exposed to huge losses. They didn't collapse. They did need a lot of help, true, a lot of policy help. They're still getting a lot of policy help, but they're not going to collapse, and the policymakers aren't going to let them collapse. So it does have implications for their profits and their stocks and so forth, and as do higher capital requirements. But it's not the situation where the financial system's going to collapse.